All right. Oh, here comes Anastasia. All right. All right. So we did a lot on Tuesday. And again, thanks. This is Thursday, November 9th. And we're all on Zoom together in all different places. And this is what we did on Tuesday. We did the perpetual inventory system. We reviewed the multi-step income statement, and we went over a whole bunch of journal entries, and the journal entries related to, if I can do that, the journal entries related to purchases. And we got more late arrivals. Come on in. The purchases. And sales. Okay. So I kind of want to go over that a little bit more today. We also posted all those journal entries to 2 T accounts, one of them being the inventory T account, which is new this chapter. We haven't worked with inventory before. And the other one being the accounts payable T account. You guys are familiar with accounts payable. Today, I want to show you the adjusting journal entry for when we take a physical inventory, and then we have to adjust the T account, inventory account to match what's in what we physically counted. Okay. And if you guys have any questions, just chime in right away, just like you would do in class. I might see your hand go up, but I probably won't. So just say, hey, I have a question. Okay. All right. So if we have time, we'll do 1 or 2 practice problems. And then I want to go back to the multi-step income statement and go over the importance of operating income. And then we'll go over the periodic inventory system, which is new. Perpetual is one method of tracking. It is now becoming the most common method of tracking inventory, companies that buy and sell inventories. And we're really talking about companies that you guys have been studying, like Nordstrom or like a grocery store, not a manufacturing company, a retail merchandising company, okay? But we'll go back, and this is part of Appendix 5A in the back of your chapter. And we'll look at what if a company has a very simple accounting system and they can't do all this fancy computer stuff because it costs money, and they use a periodic inventory system instead. And we'll go over, sorry, this should say periodic journal entries for purchases and periodic journal entries for sales. And then we'll do a calculation of cost of goods sold using a periodic system. Okay, so that's what we're going to do today. Is there anything else you guys would like to add to the agenda today? Okay. On Tuesday, so this weekend, you guys already have the practice exam. You already have the practice exam. And you should have uploaded your statements. I've checked a few statements, haven't checked them all for your project, and you should be uploading your contract tonight. So I will give you some contract time at the end of class, and you can work in the breakout rooms for that. So if you need the time. But after you write that contract, put it aside and just focus on Chapter 5, Appendix A, and focus on test review, practice exam. On Tuesday, we'll do test review. And we'll also do, I'm going to teach you how to do one more ratio. It won't be on the exam, but you'll need it for the project. And that will be the ratio inventory turnover and days inventory on hand. Okay. But that'll be on Tuesday, not today. All right. So let's look at the multi-step income statement. Everybody turn to page 70 in your course pack. And let's see if we can do. Put that over there. I'm on page 68. Here's page 70. Okay. Everybody turn to page 70 in your course pack. And tell me if this is big enough to see, guys. Can you see this? Yes or no? Yes or no?
Yes.
It's a graphic and it says sales, net sales, gross margin. Okay.
No.
Thanks.
I still see the Word document.
You still see the Word document. So let's stop sharing and let's go share again. Thanks for letting me know. Okay.
Gotcha.
All right. Now, can you see it?
Yes.
Perfect. All right. Yeah, thank you. I see that. All right. So I had you guys start working on a multi-step income statement for the Vandelay company. And that statement is, I don't know where it is. Got to go find it. It's on page way down here. Page 85. You guys were working on this. And I showed you, I had you come all the way down to gross margin. Some of you went beyond and did operating expenses, income from operations, and so forth. But we didn't get that far as a class. Okay. Let's go back to this graphic. Okay, now I'm back on the graphic. And I really want you to grasp the concept of net sales because it's a little bit complicated. In your companies that you are studying for the project, they typically don't tell you what their discounts and returns are because for the SEC information, they like to keep the information as summarized as possible. But if you worked for those companies internally, you would see gross sales minus sales returns and allowances minus sales discounts equals net sales. So what are these two new accounts? Normal balance in the chat right now, in the chat, put what is the normal balance for the sales revenue account, debit or credit? What is the normal balance for the sales account? I've got 1 comment, 2 comments, 3 comments. I'm going to stop sharing so you don't see the answer. Okay. Yes, yes, yes. And I didn't say to direct message me, so I oopsed on that. Okay. So what is, I'm going to put the question, direct message me, DM me. What is the normal balance for sales, returns, and allowances? Yes, yes. Yes, Rhythm. Yes, Savanya. Yes, Zoe. Yes, Reagan without the question mark. Yes, Han, Vincent. So keep going. I've got a whole lot less here than the others. There's probably a lag. Okay. Nope, it's not a credit balance. It's because whenever we subtract a number from another number, that tells you right off the bat that their normal balances are opposite. Because otherwise, if you had 2 credit balances, you would add them together. But sales is a credit balance, and sales returns and allowances are reversing that sale. So it's a debit balance. Okay. All right, now, everyone direct message me. Normal balance for sales discounts. Oh, I already said that one. No, sales discounts, yeah. All right, we got it. Yeah. Okay, do we add sales discounts to sales? Or do we subtract it? Good. Yes, Mohammed, you're correct. So we have sales. And go back to that screen. So you have sales here. You subtract sales returns and allowances. We subtract sales discounts, and that gives us net sales. So if sales are $500, sales returns and allowances are $25, sales discounts are $50. What would be net sales? Sales are 500, sales returns and sales discounts add up to $75. So net sales would be what? We'll put it in the chat, but I guess you can see the chat. Yes, Chaz, 425, right? So 500 minus 50 minus 25 equals net sales. So net sales is the real sales number after the returns, after the discounts. Why do we track all of this separately in 3 separate accounts? Normal balance for sales, credit, normal balance for sales return, and sales discount debit. Why do we track all that? Because if you're running a store, and if you're running like Target, the store Target, it's a really interesting number to see how much is coming back to Target. If one store has a lot of returns, maybe there's a problem that needs to be dealt with in that store. Maybe it's a store problem, or maybe more likely there's some product that's not working for those customers. Maybe the product is broken. Maybe the product is spoiled. It's sitting, like Target sells food now, so maybe there's the food inventory isn't moving fast enough, and people are saying this food is old. Okay, so just get it into your head that the real ending sales number is after we subtract all those things. In a perpetual inventory system, we also have an account called cost of goods sold. So now we have a new subtotal. We say, what is gross margin? How much money are we making on our basic products after we've subtracted cost of goods sold? It's not net income. Gross margin is not net income. It's a subtotal along the way, but it gives us the ability to look at the company at a higher level and say, are our products resulting in a high gross margin? And then we do something called a gross margin percent, where we take those dollars and divide it by net sales. Okay. All right. Okay, let's do this. Let's go back to our schedule. So well, I don't show that here. Okay, all right. So perpetual concept, new share. There, I can do new share. That's how I have to do it. All right, so let's look at, so I had these on the board, so I'm not going to go over these again, but I asked you in class on Tuesday, have any of you worked with inventory or worked at a store with inventory? And if you would be willing to share, how do you keep track of inventory? Do you keep track of it on the computer? Do you just go look and see if there's inventory? How does it work for you? So how do you keep track of inventory? Or if you're a shopper, how do you find out if they have inventory? If you have retail experience, how do you keep track of inventory? And just take yourself off of mute and tell me how it works. So if you say computer, Henry, how does it work? What kind of inventory?
I worked at Target, and we would have like little phone things called zebras, and you would scan anything that you stocked in the back room or on the floor.
So you worked at Target, carried a phone-ish thing around, and then you would scan anything that you stocked. Can you explain to everybody what you mean by stocked?
Yeah, so if you put it on a shelf in the store, you would put it in as stocked, and then if you put it in the back, it would be back stock.
But where is it coming from in the first place?
Whenever we get a shipment in, it would say that it would put everything in, but it wouldn't have it as stocked or back stocked.
So the store receives a shipment, you open the boxes, and you either take it out to what we call the floor and or backstock. And you were very specific where it was located. Was it on the floor? Was it on backstock? Okay. And then Vincent, what the heck is a distress gun? That sounds awful. Can you explain that?
So basically the distress gun is so basically it's basically like it's like a scan gun, but in order to like scan and discount. So yeah, it's normally just to check how much stock you have, and if there is less, then you can just type in how much you have left.
So
And
here's
then you
a
can also-
question. Here's a question I have for both you and Henry. So you're going around with your handheld device
Yeah.
and you say there should be, I don't know, 8 bottles of apple juice on the shelf, but
Yeah.
there's really only 6. And
Yeah.
you would key in the 6 and correct what was on the floor.
Yes.
Okay. Is
Yeah.
there any other location in the back where the apple juice might be?
Yeah, they're always sometimes they're either in the back or it's like mostly it's in stock most of the time.
Okay. And your scan gun would tell you whether it's on the floor or in the back.
Yeah.
Okay, perfect. Okay. Henry, how did you handle that? Did you have to take inventory and make adjustments?
Yeah, so there was like team leads who every day would go back through and adjust it because it would be wrong a lot of the time.
Yeah, yeah. Every day you checked the balance and compared it, right? Compared it to what was in well, you're calling it a scan gun and you're calling it a zebra thing, and
Yeah.
compared it to, I'm just going to call it the handheld computer. Okay. If an error, you corrected the computer to agree with what you physically counted, correct?
Yeah.
Okay, every day or whenever you correct it. And I'm going to show you how to do that journal entry. The computer to agree with what you physically, that's an important word here, counted. All right. Now, in the old days, I would go to the store and I would say, I need apple juice. They would look in the system and they would say, we have 8 bottles in the system, and they wouldn't know whether they were on the floor or in the back. And so in the last 10, 15 years, they've finally gotten that better. And so they're able to, they're actually able to be more specific in locations, which has made people in retail's life a little bit better. But anytime you pull something from the back, you have to do something different, right, Henry? If you move it from the back stock to the floor, you have to rescan it.
Yeah.
And Vincent, same thing? Vincent, if you move something
Yes.
from the back to the floor,
Yes.
you have to rescan it, right?
Yeah.
Okay. Okay. So we're just tracking, and you can see it relies at this point in time, it relies on human beings to monitor and move and scan things. Okay.
Yes.
And maybe someday it'll be a robot. Hopefully we'll still all have jobs, but maybe we'll do different jobs. Okay. So I want to talk about that as well. All right. So great. Those are perfect examples, and thank you. So new shipments come into the store. You've already explained that. You scan them, you move it from the back to the front. Do you ever move inventory to other stores, Vincent or Henry? Or no?
Sometimes if other stores ask, like if other stores are like out of stock, but since we have like extra stock, we can give some to them.
Yeah.
Like I mean, like for our Safeway, we do give it to other like smaller Safeways.
Okay. What would be an example of something you would give to another Safeway?
Connected this. I can actually relate to this one. It's not a product necessarily. It is for a grocery store. I work at a grocery store, and we get our shipments in on Mondays and Wednesdays for our food and our produce, but we also get a shipment for bags. for grocery bags. And sometimes we run out before
Mhm, mhm.
the shipment arrives. So someone has to run down to another store and pick up more. So in that scenario, we would be asking another store for help, like because we ran out of bags and we won't be able to continue with the store unless we get more.
Right.
So
Absolutely.
typically it's fine, but sometimes a shipment is missed and we need help. So someone will run and pick them up and then bring them to our store, and then vice versa.
Is there a scanning that happens on the bags? How do you track that it's no longer in the first store and it's now in the second store?
So those are scanned out and
Mhm, yeah.
to our store. So we have an inventory of how many bags are at each location.
Great. Those are really good examples. All right. So we're moving inventory around. So because you guys have those zebras and scan guns and little miniature computers, that is a perfect example, all of that, of a perpetual inventory system, where at any point in time, you can look and say, we're supposed to have 8 of these. And then because retail has so much movement of inventory, they do physical inventories all the time. Every day, you guys are out on the floor checking the balances often, maybe not every day, but often. And you're making adjustments all the time, because if the customer is looking for a product, you can't have the computer not be accurate. So it's perpetually updating. And so let's look at the journal entries you guys built yesterday, or Tuesday rather. So we're going to go to page 76 and 77 in your course pack. We just scroll down here. And this is page 76. And actually page 75 is that invoice that we started with, where the seller is Judith and the buyer is Jennifer. And so what we did was we said, first, let's look at the purchase transactions for the buyer transactions. And we had 4 transactions here. We had Jennifer purchasing calculators, Jennifer paying a freight bill, Jennifer returning 2 calculators, and Jennifer paying the balance on the bill. You guys good? Everybody there? You guys need more time? Okay, so let's go look at real quick. So let's look at these transactions. All right. Yeah, I see it. Thank you. Let's see if I can do this. Make it a little bigger. Okay. So we said Jennifer purchases, and if you look at your course pack on page 76, you have the description of the transaction, and then this is the journal entry. So I told you on Tuesday, you don't need that word merchandise. You might need it for your online homework, but you don't need it for my class. So we debit inventory. Inventory is an asset, and we credit accounts payable. How did we know it was accounts payable? We go and read the prompt. And what did the prompt say? I don't have the prompt in front of me, but I have it on my screen. The prompt said, we sold, let's see, I guess I do have it. Let's see if I can find my prompt. No, I didn't. I had you guys write it in on page 76. Jennifer purchased calculators from Judith's calculators. And the terms are 210 net 30. Okay. And what does that mean? Put it in the chat. What does 210 net 30 mean? Real quick. Direct message me. 210 net 30. Zoe, you are correct. Yuval, you are correct. Anna, Anastasia, Casey, good, good, good. Good, okay, so let's go back and. So 210 net 30 means you pay the full amount in 30 days, but if you pay early, if you pay in 10 days, you get a 2% discount. So you only pay 98%. Okay, so that means we're not paying cash today because we don't have cash. We're going to pay in 30 days, or if we take that discount, we'll pay early. So debit inventory, credit accounts payable. And we talked about FOB shipping point, which is the most common, which means the buyer owns it at the shipping point, not when the buyer receives it. They own it when they receive it, but ownership transfers at the shipping point. And that's the most common, FOB shipping point. Sometimes we do FOB destination, which means title doesn't transfer, ownership does not transfer until we get to the destination. This is important because it means who pays the freight bill. FOB shipping point means if the buyer owns it, they pay the freight bill. And that's the most common. Okay. So FOB shipping point. So here we go. The buyer, Jennifer, is paying the freight bill. The freight bill is $140. And for a perpetual system, everything gets charged to inventory on a purchase. So the freight bill, why? Because it's like buying a car. You don't pay the base price, you pay the transportation as well. So we add this to the cost of our inventory. Debit inventory, credit cash. Okay. If the terms were different, if the terms were FOB destination, the seller would pay the freight bill and this would be the journal entry, but they're not. Okay. All right. Yeah, Vincent, go ahead. You're on mute.
Why is the freight bill paid with cash?
Isn't that a crazy question? So yes, the freight bill is paid with cash. And that is how we teach this, because the freight companies demand that we pay in 10 days or less. And so effectively, it's just we get the bill and we pay it, because by the time we've got the bill, some time has already passed and it's from date of shipment. So we just pay it immediately. If we don't pay the freight bill, the freight companies won't ship to us. It's sort of a questionable practice, but that's how it works. Okay. So when we do a return, notice that the return is just the same as the purchase, but it's flipped. Why? Because we're reducing our accounts payable with a debit, and we're reducing our purchase amount by the credit. So we have less inventory because we're returning some. And then finally, we pay our bill and we say, well, how much do we really owe? We don't want to pay $1,400 bill because we've returned $130. So we're going to pay the net, what we call the net bill, which is the original amount minus the return, and that's $1,270. So we clear out the $1,270 from accounts payable, and then we calculate the 98%, which is $1,245, and the 2%, which is 25. And I asked you guys, don't put pennies in just on tests, just because it's easier to grade. So please round to the nearest dollar. Okay, so we debited inventory for the original purchase. We credited inventory for the return, and now we're crediting inventory again for the discount. So all of those costs it takes to buy that product. All right. If we paid in 30 days, we'd just do what you did last couple of chapters: debit accounts payable, credit cash. Okay. All right. All right. So if you turn in your course pack to the T accounts on page 78, please, you'll see that 1385 there. And if you don't, go ahead and if anybody needs more time, ask me for more time. Just put time in the chat. But I want to make sure that you have this in there on that page. Okay, so now I want you to imagine that you are Henry or Vincent or Joe. And that is what you see in your computer. Inventory balance should be 1385. Now, what they described is actual quantities. And that's really what's relevant here. But I'm going to use dollars for this example. So let's say they look in their computer and they have 1385. And they go out and count and they only have 1300. They're keying in the difference and saying, this is what we really had. So in the computer, an adjustment has to be made, because if we want inventory to be $1,300, in the chat, tell me, what do we have to do to inventory to make that happen? So let me write this in the chat. Let's say the computer says inventory is 1385, but we physically counted 13. How? Okay. What do we do to make the computer get to 1300? How do we get it there? Debit or credit? How much? Kirsten, next time do a direct message. So yeah. So right now the balance in the inventory account is debit 1300. Currently, the inventory balance is debit, sorry, 1385. How do we get the inventory balance to 1300? We credit inventory 85. Yeah, good. All right, so at the top of page 78, I want you to make that inventory adjustment. So let's start building that journal entry. You guys know it. The adjusting entry is we're going to reduce inventory by $85, and we are going to credit inventory $85. All right, let's see if I can find a blank page here. Okay, so we're over here on page 85. I jumped ahead. We're right here on page 78. So build just in this box right here. I want you to, let's see if I can. I'm going to credit inventory. Oops, didn't like that. I'm going to credit inventory $85. Okay. So in accounting speak, we would say we are writing down this inventory $85 because it's norm. I'm going to credit it. Let's make it look like a credit. Okay. So journal entries have to balance. So I need a debit to something for $85. Now, in the business world, when we lose inventory, so in my example, we have lost inventory, we have to write it off as an expense. And some companies have an account called inventory loss expense. But in a lot of companies, we just charge it to cost of goods sold, because ultimately that's what it is. It's a cost of doing business. If we're going to run a Target, if we're going to run a Safeway, periodically we lose inventory, either to shoplifting, or maybe we actually lost it. It's somewhere else in the store and we can't find it. It's effectively lost. So we write down the inventory $85 and we debit cost of goods sold $85. And what is this going to do to our profit? It's going to lower our profit $85. Okay. All right. All right. You guys got that? So that's our adjusting journal entry. So be sure to write that down. Everybody good? All right. No, go away. All right. So what else did I want to go over with you today? That didn't take long. Okay. Let's look at the multi-step income statement one more time and let's do that. And then we'll go on to the other. All right. In your course pack, the multi-step income statement example is on page 85 in your course pack. So let's look at that. And we started out with, let's go to Vandelay. So here's the example one, okay? Sales revenue minus sales returns and allowances. And we got net sales, and everything pink here is a calculation. Everything non-pink is, well, this should be pink, but all of these are accounts. And we got down to gross margin, and you have this example in your course pack. Then we subtract and we list all the operating expenses. So I want you to pay attention to the operating expenses: salaries, utilities, advertising, depreciation, freight out, and insurance. And then income from operations, we're still going. And income from operations, 20,000. And then we have these other items here, and then we get down to net income. Okay. So we went over this last week, but I just want to go back and talk about operating income. So let's go look at this company. Net sales, gross sales of 250, net sales of 237,000. Income from operations, or you can call it operating income, is 20,278. Okay. And if we went all the way to the bottom after these other items, we'd have 16,782. But I want to focus on operating income. It tells you how well the company's doing business on a go-forward basis at their basic business level. Company like Starbucks, company like Amazon, company like Target or PACCAR or Nordstrom, how much money are they making? And then you compare it to your peer competitors. Okay. The other income and the other revenue, those are like one-time events. The operating income is what we call the sustainable income. And I just can't overemphasize that. That's a very important number. It's like the gold standard for how a company's doing. Okay. All right. Now we're going to move away from the single step income statement. That's what you guys have been doing up to chapter 5. And we're going to stay with the multi-step income statement. But just for an example, the single step income statement, you'd lump everything that's a credit balance here, anything related to sales would be here. Anything related to interest revenue, other revenue would be here. Then you'd subtract all the expenses. You know, we don't want that. Okay. All right. We are at a point where, let's see, it's 11:16. Do you guys want to break? Yes or no? You guys want a 5-minute break? I got 2 yeses and 1 no. 3 yeses and 2 nos. Okay, let's take a 5-minute break. Grab a cup of coffee or whatever, and we'll start with the periodic journal entries.
Okay. All right.
If anybody has any questions, let me know. start the recording again. And can you hear all that construction noise in the background, people? Please tell me you can't.
No.
Good, thanks, Zoe. All right, so let me share my screen again with you. And I realized I had forgotten to review the sales side of the transaction. So let me go back and do that as well. All right. So we did the purchases, and now let's take a quick look at the sales transaction. So now we're flipping, and at the top of your page, on page 77, you should have the names here. Oh, good. One more person here. And on the first column, it should say Judith's books. On the second column, in the first column, it should say Jennifer's books. On the second column, it should say Judith's books. So this is the first time we've done this in class where we're showing two sets of books for the same transactions. So it's a little bit of a head thing, and you're going to have problems, and there's going to be names in the problems, and it's really important that you jot down which one is the buyer and which one is the seller, because if you get them backwards, your journal entries are going to be wrong. So now we're saying, let's do the seller's books, and the seller in this case is Judith's Calculators. So same transactions. Now, with a perpetual inventory system, we're tracking that cost of goods sold, and we're tracking that inventory all the time. So on Tuesday, we said we sold that 1,400. And this is these first two lines are familiar: journal entry, debit accounts receivable. Now, instead of service revenue, it's sales because we're selling product. But now we have to book cost of goods sold. We've increased our expenses by the cost of the inventory. We decreased our inventory because we've taken it out of inventory and sold it to a customer. And the problems will give you cost information, or they'll give you a percentage. They might say cost of goods sold is 75% of sales, like I did in this problem. Or they could say gross margin is 25%, and you would have to calculate what cost is, which would be 75%. So 4-line journal entry, and all your homework is just going to be the same journal entries, but with different numbers. Okay, here's the return transaction. And now we're using that new account, sales returns and allowances, and crediting accounts receivable. And then again, we applied that 75% for cost on the 130, debit inventory, credit cost of goods sold. And finally, we say, now we got paid, Judith got paid. And again, it's the net amount, the 1,400 minus the return of 130. So we credit accounts receivable because we've been paid, but we only debit cash for 98%, and we book the 2% to sales discount. All right, so that's the ending of those. Okay, and then we already showed you the adjusting journal entry. Okay, so now we've looked at the multi-step, and now let's go to periodic. All right, so I'm going to have you guys move to page 79 in your course pack. We're going to book the same transactions using the periodic inventory system. Now, in a way, you've already done the periodic inventory system in a previous chapter, and you did it in the supplies account. The supplies account in chapter 4, we said, hey, we bought supplies for $800, and now at the end of the month, we only have supplies on hand of $200. And then you had to book credit to supplies, $600, debit to supplies expense, $600. Okay. So we're going to do same thing with periodic. All right. So what Henry and what Vincent and Joe described was a perpetual inventory system. Small companies who can't afford the fancy computer systems cannot buy them, use a periodic inventory system. Great big companies for certain products, use a periodic inventory system. And let me give you an example. Home Depot and Lowe's, big hardware stores. There's that one aisle, that one place in the store where you can buy, I don't have a picture of it. It's like nails and screws and fasteners, and it's little items. They don't track those little items that closely. They don't cost a lot of money. They cost 20 cents, something very low. And periodically, they update the inventory balances. So how do they do it? They just track all their purchases. If they do a return, they do a journal entry for the purchase return. But then at the end of the month, they count the inventory and adjust it, just like we just did. Debit, cost of goods sold, credit, inventory. Okay. All right. So the way sales revenue side works is the same, except we only book the sales journal entry. So let's book the first journal entry for sales. So we're going to be on the right side of this. I know when we did the other example, we started on the left, but with periodic, I want to start on the right because it's a little bit easier. Okay. So to book the sale, this is the same transaction. We're just using a different inventory system. We're using periodic. So as you approach your homework and as you approach the exam, your first question is, which system am I using, periodic or perpetual? Because that's going to change everything. So book the sale for Jennifer's office supply. Debit accounts receivable, credit sales. That should look the same as part of your journal entry using the perpetual system. What we're leaving off in periodic is that cost of goods sold and inventory, because we don't know how much we're selling in terms of the transaction. Okay. And when I use dollars here in your head, I want you to think what Vincent and Henry said, where you're actually tracking the items and that the dollars are just representative of the item times their cost. All right. So for a periodic inventory system, so your second box here, let's go look. Go find that. It's not going to work. Let's see. New share. Make sure we're all on the same page. Okay. Okay, this is perpetual. So let's go to periodic. We're on page 79. We've just booked the sale. Right. Debit accounts receivable, credit sales, $1,400. Now this box here, we're not going to use because the terms were FOB shipping point. So the buyer pays the freight. So the seller, we just leave this box blank. And now here we say, how do we book the return? Okay. And that's going to be the same way you book the return for perpetual, but we're not tracking the inventory. Okay. So we're going to say sales returns. I'm going to abbreviate this. Sales returns and allowances and accounts receivable. Oh, I don't want to turn like that. Here we go. Oh, that's funny. I don't know why it did that. Sorry, it's wonky. And what was the value of the return? It was $130 and $130. Okay. So let's look at it over here. All right, sales returns and allowances and accounts receivable, 130. Again, we're not debiting inventory. We're not crediting cost of goods sold because we only calculate that when we take physical inventory. And finally, how do we get paid? It's the same journal entry for both perpetual and periodic. Debit cash, debit sales discounts, credit accounts receivable. Okay. So make sure you have all this written down. And that's your selling transaction. So if you were to compare the two side by side with perpetual, The sales transaction and the return transaction have 2 extra lines for inventory and cost of goods sold. That periodic doesn't. Okay. All right. Let's look at the buying transactions. Okay. So the way the buying transactions work for periodic is we don't use inventory at all. We only use inventory account and cost of goods sold account once a month or once a year whenever we take physical inventory. For the periodic, we have new accounts, and you're going to have to learn them, and they're separate accounts for purchases, for freight in, for purchase returns and allowances, and purchase discounts. So we just count the inventory periodically, and then we calculate cost of goods sold, and then we update the inventory account. All right. So over on the left are the names of these new accounts. Okay, purchases, purchase returns and allowances, purchase discounts, and freight in. We only use these accounts for periodic. For perpetual, all of those accounts are either a debit or credit to inventory. Okay, so this is how we calculate cost of goods sold. So let's look on your course pack, and you have this in there. So let's go look at that. Let's do a new share. Go back to your course pack, and I want you to go to page 82 in your course pack. That's that same thing. Okay. So brand new accounts here. And I have a picture of it as well. So let's look at the picture. Let's go back here. I like pictures more. All right. This is my picture. That is on page 69. So go to page 69 in your course pack. So you will need to know how to calculate cost of goods sold using a periodic inventory system. We're going to do some journal entries, but you're going to need to know how to do the actual calculation. And see down here, this ending inventory, that is what Henry and Vincent were talking about, but they did it by product. They're saying, no, there's 6 bottles of apple juice on the shelf. I'm sorry, that I counted, 6 bottles that I counted. I don't care that the system says 8 bottles. It's really 6. And that system, and they keyed in the physical inventory, and then the computer makes that journal entry. And you do it for both systems, by the way. You do it for periodic, and you also do it for perpetual. For periodic, the one we're learning now, you have to do it. It's the only way we know how to calculate ending inventory, okay, and cost of goods sold. You calculate ending inventory based on your physical count, and then you back it out of what's available, and that tells you what you sold. All right, so how do we do this? So take your hand, and there's 5 fingers on it. All right. So we start with beginning inventory from last time. So whatever our beginning inventory was your ending inventory was last month or last year. Start with that. Then we add, see that plus there, we add our purchases. That should make sense to you. Purchases increase inventory. We subtract purchase returns and allowances. That's stuff we send back to the supplier. We subtract purchase discounts. That's when you get a 2% discount. Okay. And we add freight in. Okay, 5 things are combined together. Beginning inventory, plus purchases, plus freight in, minus purchase returns, minus purchase discounts, equals goods available for sale. And we're going to work with goods available for sale again in chapter 6. So it's important for you to wrap your head around that concept. This is all numbers, okay? So we say, this is what we counted last time. Okay. Now we've paid the bill for purchases. We've made some returns, we've deducted that. We've gotten purchase discounts, we've subtracted that as well. We've added our freight in. This is what the books tell us that we had available to sell. Now we send people out to count the actual inventory and they say, here's the inventory. And we say the difference is cost of goods sold. Now, anybody that works in retail knows there could also be in that cost of goods sold number theft or loss due to employee error, but we just lump it. We know the majority of this, 99% of this, is cost of goods sold and expense. Okay. All right, so let's go back to the calculations on page 82. Go to page 82 in your course pack, and you see these numbers here. Beginning inventory 11,000 plus purchases. There's your hand again. You got to get to 5 to get to goods available for sale. Beginning inventory plus purchases, and then you can see less returns and allowances, less purchase discounts, add freight in. Sorry for the pennies there. I should have fixed that. And then goods available for sale, 154,050. And now we're going to subtract. Now we're going to go out and physically count. We have only 11,850 on the floor. That means we sold 142,200. Cost of goods sold. With a periodic inventory system, you have to take physical inventory to know what you have, and then you use that number to calculate cost of goods sold. Okay. With perpetual, you still have to take physical inventory, but it's so that you can make corrections along the way. Okay. All right. So let's look at some of those journal entries. Okay. All right. So let's go, and we're going to be working in new share. We are going to be working with page 79 in your course pack. Share this. All right, share screen. We're going to go back to the course pack and go to page 79. And now we're working in this left-hand column. So on the seller's books, please write Judith, and on the buyer's books, please write Jennifer, because you really want to keep that straight. And you need to do that for all your homework problems. Who's the buyer? Who's the seller? Because you are going to get homework problems that give you one set of data and they say, book the buying transactions for the buyer. Now book the selling transactions for the seller. Same transactions, but different journal entries. Okay, so to record the purchase of an item from the seller. So let's go look at our prompt. Remember, they bought $1,400, but now we're using periodic inventory system. We're not going to debit inventory. We're debiting purchases, new account, but we're still crediting accounts payable. Okay, so write that in as your first journal entry. And we're going to do a total of 1, 2, 3. We're going to do 5 journal entries on this page. And make sure to put the date in. It's February 4th, 2014. Dates become really important with this chapter because we need to figure out if we can take the discounts. All right. If you guys need more time, put it in the chat. Otherwise, I'm going to move on. If anybody needs more time, say more. Just put time in the chat. All right. Nobody's putting anything in the chat. All right. Now, what did we do next? We paid the freight bill. In the perpetual system, we used a different account, but in periodic, we're using a new account called freight in. It should say freight in expense, but it is tradition to drop the word expense. But this is an expense account, freight in and credit cash. Second journal entry, debit freight in 140, credit cash 140, and put the date in as well. All right, third journal entry. We return items, we return two calculators. Debit accounts payable, that's the same as the other one, but new account, credit, purchase returns, and allowances for 130. And you can abbreviate that as purchase RNA. And after we go through these journal entries, I want to give you some practice problems. Anybody need more time? Put time in the chat. I don't see any time. Okay. All right. Next one, we pay the bill. Just like in perpetual, debit accounts payable for the money owed, $12.70. Credit cash, $12.45. And here's where it's different. We credit purchase discounts, $25. Now, the next journal entry is an alternative journal entry. Oh, I got a question in the chat. Let's see. Okay. Wait. Good. Any questions so far about what we're doing? Okay. Let's take another minute. All right. Good to go, everybody? All right. So the next journal entry is, what if you did not, what if Jennifer's did not take that 2% discount? What would the journal entry be if she just paid the bill in 30 days? And that is going to be, oh, I didn't show it. So tell me what it is. Put it in the chat, direct message me. What happens if she takes, stop share, give me the journal entry. If Jen pays bill in 30 days. Direct message me, please. What is that journal entry? Casey, you are correct. Good. Reagan, you are correct. Anastasia, yes. Henry Holtrup, yes. Farine, yes. Okay. So it would be going back to this journal entry. We know we owe $12.70. So it would be debit accounts payable $12.70, credit cash $12.70. Okay. All right. So then here we have that same statement that we just went over in the course pack. So I have on page 80, I think I have it in your course pack. Page 80. Maybe not. Forward. Here we go. It is page 83 in your course pack. Okay. So the way it works when it's time, when it's finally time to take that physical inventory. Okay. So let's go back and look on page 82. in your course pack. So I had you guys calculate cost of goods sold, or I showed you the calculation for cost of goods sold, 5 items, right? Beginning inventory, purchases, less purchase returns, less purchase discounts, plus freight in equals goods available for sale, minus ending inventory equals cost of goods sold. Okay. So now, what does your T account say for inventory? Your T account says 11,000. But you physically counted 11,850. So how are you fixing that? How are you fixing inventory? Put it in the chat. Debit or credit, and how much? I want to get from 11,000 to 11,850. How do I get there? I'm going to stop sharing and see what you guys tell me. Zephania, you are correct. So the inventory T account says 11,000. We count 850. What is the adjusting journal entry? Henry, you're correct. I mean, don't give me the whole entry, just give me the impact on inventory, because it's a big journal entry for periodic. Okay. Casey, correct. Anybody else? T account says 11,000. We counted 11,850. We're going to debit inventory for $850. So let's start building that journal entry. And it is right here. You can do it without making it too weird. Here we go. Come back. Here it is. Okay. So we need a debit to inventory of $850. That much we know, okay? We may not know anything else, but when we're done, inventory is going to be 11,850 because we're debiting inventory 850. Okay. Now let's go look, and all these 4 new accounts, purchase returns, purchase discounts, and freight, have to go to 0. Okay. So purchases has a debit balance of 143. Freight in has a debit balance of 13,003. Purchase returns and purchase discounts have credit balances. Okay. We're going to talk more about that, but before we go anywhere, I want cost of goods sold to be 142,200. Okay, so let's do that piece. And we're going to finish this on Tuesday because I want to do something else. But so we're going to debit cost of goods sold. And it's going to be debited. How much? 142,200. All right. It's not lined up real pretty, but that's what it's going to be. All right. What happened? We're now periodically saying what is cost of goods sold. We calculated it on the previous page, and what is the adjustment to inventory. And then all you have to do to close out this journal entry is, this is a closing journal entry. We get rid of these 4 accounts because we use them for the period. The period is ended, and now we're updating inventory and cost of goods sold. Okay, so I'll show you the entry, and so we had all those balances. So here's your 850, here's your 142. Purchases had a debit balance, we're crediting it. Freight in had a debit balance, we're crediting it. And these 2 accounts had credit balances, so we're debiting it. But we'll go over this again on next Tuesday. All right. Okay. So the main difference between these two systems is when we calculate cost of goods sold. Perpetually, we perpetually do it. Periodically, we do it once a year, once a month. Whenever we want to issue financial statements, but we have to take a physical count to do it. Okay. We still have to take physical inventory with perpetual because as Henry and Vincent and Joe said, or Henry and Vincent said, it's not, the system is not always accurate. So they're checking the accuracy. Okay. On my slides and in the back of your textbook, there's a nice side-by-side comparison. So the first graphic is the purchases. Here's how we do it for perpetual. Here's how we do it for periodic. And then on the second slide, it shows sales. Here's how we do sales for perpetual. And here's how we do it for periodic. So it's kind of a nice reference sheet to do. And remember, all your homework problems are just the same problems with different numbers. Okay. All right. Let's do a practice problem. Okay. And see if I can bring that up for you. I want to put you guys.
你去买啥呀？
Okay.
Pizza.
All right. I'm going to put this up for you guys. And then I'm going to put you in breakout rooms for
No.
5 minutes to do these problems. Okay. Let's see if we can. Wait a minute. I don't want you to see.
就是打个框像那种。
因为他就我上面这个课已经没有了。
All right. We're going to do purchasing transactions. And I'll let you take a picture of this. Let's go. All right. So I'm going to put you in breakout rooms of 6 people. And just join the room. You can join any room, but join the room of your normal team number. So team 1, go to breakout room 1. Take a picture of this. Company purchases items for $250. I want a journal entry. Company returns items for $35. Company pays a freight bill for $25. Company pays the bill. Now, your first question to me is perpetual or periodic? Okay, so everybody take a picture of this because it won't go in the chat easily. It'll look ugly in the chat. Okay. Everybody got it? Anybody need more time? Okay. All right. Let's go. Break rooms. I'm going to make 6 rooms. And I'm going to give you guys 5 minutes and I want 4 journal entries. So work on it individually. And then at the end of the time, maybe somebody type it up for the whole group. Okay. All right. So I'm creating the rooms now. I'm opening the rooms now. So let's see you go. Go into your regular breakout, your regular team rooms. So nice. Team 6, you are on your game. That room is filled. Okay. And go in your usual room. Mona, go to team 3. Kathy, team 3. Chaz, I think you're in team 4. Danny, you're in team 5. Carla, you're in team 2. Lewis, you're in team 5. I don't know who Ziyang is. Who is Ziyang? Kathy, what do you need? Oh, you didn't get the breakout room? I'll move you. Danny, can you hear?
Yeah, I can hear.
You are team 5. Do you need me to assign you?
Yes, please.
Louis, do you need me to assign you?
Yes, please.
I will do it. And Ziyang, who is Ziyang?
I'm Evie because I don't know how to
Evie,
change my
sorry,
name.
Evie.
Yeah, yeah.
I
I'm
will put-
sorry.
No problem. I'm gonna put you in team 3. All right. Rhythm, are you there? Yeah, he's back. This is super easy, yeah. Did you get bumped out? Mona, did you get bumped out?
Yeah,
Okay, I'm gonna put you in room 3.
yeah. Thank you.
Uh, you can see. You guys solve it?
Yes.
All right, that's good. Close on. Give people a minute to come out. They're still in there. They'll get kicked out in a minute. Which method did you use, Reagan?
Periodic.
Oh, good. Okay. Did you write it up? Did anybody write it up?
Yes.
Can I have you when it's time, can you share your screen? Or yeah.
Yeah.
Okay, perfect. All right. You guys should be out. Everybody out of the rooms? I think so. All right. Okay, we're back. So I'm going to ask Reagan. Reagan solved the problem using periodic method. So I'm going to ask him to share his screen for the purchase, the freight bill, the return, and the final payment. So go ahead and share what you got. This is periodic. Debit purchases, credit accounts payable, debit accounts payable, credit purchase returns and allowances, debit freight in, credit cash. Ooh, what happened there? Third journal entry, and then, so walk me through entries 3 and 4.
So 3 is returns item for 35. I just kind of went by the example and
Sure.
just copied like what we did for the second journal entry of the example. So I did so I went freight in 25 and then cash. Oh, I think I just put the wrong number there. Okay. Was that the only problem with it, or is it
That's the
part
only
of that
problem
number?
with it, yeah. And then
Okay.
the last one, did you explain what your assumption was on the last journal entry?
I assume we don't have to pay 35 or 25 anymore, so I did 250 minus 35 and 25, and I got 190.
Okay, so your assumption was, yeah, what the freight bill doesn't affect the supplier. The freight bill is UPS or a freight company, so that's a different transaction. But from our supplier, we bought 250, the buyer bought 250 and returned 35. And how did you get the 190? How'd you
Well, I
calculate?
did 250 minus 35 and 25, but it should be just 250 minus 35.
Correct. So that would be what? What would be the dollar
Oh,
amount?
215.
I'll take your word for it. I can't do math and talk at the same time. Okay. All right. So then that is correct. When did you pay the bill? So let's say you did that first purchase on the first day of the month. When did you pay the bill? Did you pay it in 10 days or 30 days?
I don't know.
Okay, that's fair. Anybody else? When did he pay the bill? You can put it in the chat. When did he pay the bill? And I mean, we don't know the exact day when the bill was paid, but yeah, 30 days, no discount. That was what I was going for. So Henry, yeah, and Zoe, yeah. So in this example, he's saying we just paid the regular bill. We bought 250, we returned 35, we owed 215, and we're going to pay it when it's due 30 days later. Okay. Now, if you were going to do a bill and take a 2% discount, how much would that, can you give me a new journal entry for that? So did anybody get different answers if you did periodic? And I'm gonna. Anybody get different answers? What is it? Who else got the answers to this problem? Anybody else? So what would be the answer if we had taken that discount for the payment? Okay. So let's go back and look at the PowerPoint. We are doing periodic and we're paying a bill. You debit accounts payable for the full amount. In that case, it would be $215. And then you'd take a 2% discount. And then cash would be the balance. Okay. Right. Okay. So let's do another one. Did anybody do perpetual?
I did perpetual.
Okay. So let me look at these again. So company purchase, company returns, company pays. All right. Go ahead and share your screen. Yuval, if you have it.
I'm pulling it up 1 second.
Perfect. Oh, I like that. Nice.
Does that work? Can you see
Yeah.
it?
Yeah. Walk us through the transactions.
So for the first one, it was inventory 250 for the credit and debit of accounts payable of 250. For the second one of the return, it was just the opposite of
Yep.
$35 each. For the freight, it was 25. So inventory and cash, and then
Yeah.
I did it similarly of without the 210, but the net 30 instead.
Perfect. Yeah. And I didn't tell you that there was a discount. So you guys were literal and you followed the instructions perfectly. Okay. One more practice. So let's do a sales transaction. Let's say company sells item with a gross margin of 30% to a customer. Same customer returns some items, same gross margin. Customer pays for money owed and takes a 1% discount. So let's just put some dates here. We'll say 11/1 and 11/5 and 11/11. Okay. So take a picture of that. And in this one, you can do perpetual or periodic. Okay. You decide and just come up with those 3 journal entries. Okay. And I'll open, everybody good? I'm going to open the breakout room now. Let's see, just put this here. And let's do that. All right, go on into the breakout room and you have another 5 minutes.
It's gross. Hi.
Hi, any questions or are you guys good?
I think we're good.
All right,
Great.
awesome. Any questions? Or are you guys good?
We're good.
Okay. Hey, Mohammed, you're in team 4. Do you want to join your team?
Oh, team 4?
Yeah.
Yeah, sure.
Okay, I'll move you.
How I move it?
I just did. Hey, Rhythm, can you join your team? You are in team 2. Rhythm, can you hear me? You're in team 2. You're on mute. Okay, I'm closing off the rooms. It'll be another minute. And then we'll share screens and see what we did.
Recording in progress.
Okay, we've got 8 seconds and then we're gonna go over the answers. And then they'll all get kicked out. All right, here we go. Let's see. Okay, we heard from team 1 and team 6 last time. No, we heard from team 3 and team 6 last time. Anyone else want to volunteer their answers? Who has answers to that problem? How about team 5? Do you guys have answers or looking at our team two.
I can volunteer actually, but I'm not sure I'm right or wrong.
All right, can you share your screen or did you just write it down?
I just wrote it down on the paper.
Okay, talk us through it.
So on the first problem, I did account receivable on 750 in debit.
First question, Mohammed, perpetual or periodic?
I think I did periodic.
Okay, so on the first one you did. Go ahead.
750 for the debit account receivable.
Okay, so I'm gonna write that here. Let's see if I can move this. Accounts receivable. Debit 750. All right.
Yes, and sales revenue 750 for credit. That's the second line.
And I'm just going to call it sales because I'm lazy. So, all right. And this is periodic.
And third line would be cost of goods sold for 250 is going to be debit.
Okay, I'm going to stop you there and let's take a quick look here. You're doing periodic and we're doing sales. So we don't have any entry for cost of goods sold.
Okay.
We only do it for perpetual. Okay, so this entry was actually correct. Let's go here for the return and see what you've got.
Oh, I didn't do that one actually.
Okay, anybody else? So I'm showing you these for periodic. Anybody else have periodic? So quiet. Okay. All right, we'll pick up with that next time. And then I want to show you one more thing in your course pack. So where's the course pack? So I had you guys working on, I gave you a blank form and I said, work on page 84 and give me a perpetual multi-step income statement. And I said, use this form here. And then there's another problem with periodic and we didn't do this. We'll do this on Tuesday. Calculate cost of goods sold. And then there's a form on the next page for that. All right. If you want to go ahead and do it, you can go to my PowerPoints. And here's that same prompt. And I have the solutions here if you want to check your work. So we have the multi-step for perpetual with the solutions for Vandelay Company. We have calculation of cost of goods sold periodic solution. All right. Okay. So now I'm going to tell you guys goodbye. And on Tuesday, you have a lot to do between now and Tuesday. You've got to post your practice exam problem. You've got some homework to do. You've got homework part 1, chapter 5 due tonight. You've got homework part 2, chapter 5, I think due Sunday night. And you've got a quiz Monday night on chapter 5. So you got a lot of, chapter 5 is a dense chapter. So that's why we only do 2 chapters on the second exam. Okay. On Tuesday, we'll do test review. We'll go over a couple of ratios, inventory turns, days inventory on hand. And we'll get ready for that test on Thursday. All right. I will see you guys later. Thanks for being flexible and doing Zoom with me.
Thank you. Bye.
Thank you.